Welcome back to the podcast. This episode, we are joined by Mr. Jamie Murray, Portfolio Manager at the Murray Wealth Group, a Toronto-based investment firm with approximately $360 million under management. Mr. Murray has roughly 20 years of experience in the investment sector with previous roles at Investors Group, Desjardins Capital Markets, and Dundee Capital Markets. Mr. Murray graduated from the Richard Ivey School of Business and also has a CFA designation. Among other things, we discussed out-of-favor stocks, protecting capital, energy tariffs, and market opportunities in 2025. This podcast episode is powered by ATB Capital Markets. ATB Capital Markets provides financial solutions and strategic advisory services to help businesses thrive. With a track record of successful deal execution, ATB is a full-service investment dealer with a deep understanding and commitment to the industries it serves. Visit atbcapitalmarkets.com for more information. This podcast episode is brought to you by EVA. EVA is a next-generation analytics platform powered by McDaniel Research and tailored specifically for oil and gas to quickly derive insights that matter to energy operators, investors, and advisors. EVA is the only platform that leverages public data, your in-house operator data, and exclusive data sets interpreted by professionals at McDaniel Research. This combination allows for rapid analysis of the most complete data possible, enabling better decisions around A&D, completion design, and optimal field development. Visit turinganalytics.net to learn more about leveraging EVA to uncover hidden trends, make informed decisions, and stay ahead of the competition. Good morning, Mr. Jamie Murray. Thank you very much for doing this yet again.
Thanks for having me on, Trevor.
For the listener, as a recap, you are a portfolio manager at the Murray Wealth Group. But what is the Murray Wealth Group?
So the Murray Wealth Group is a Toronto-based investment manager. It's mostly private client, but we're just launching our two pooled funds that we run on the FundServe platform, so they would be available to financial advisors right across Canada. We have about $360 million of assets under management and growing very quickly. We started, I think, with about 40 million in 2015. And so almost a 10 size the company over that time period and hoping to do that again over the next decade.
Last time we spoke was in Toronto when I did an episode with your dad, Bruce Murray, who is the namesake of the company, on a snowy day. So it's great to see you again.
Yeah, it's great to be here in the great city of Calgary and doing this in person.
I enjoyed Toronto. It was the first time there, so it was great.
Yeah, it's a great city. Always something going on, always lots of lively action. But, I spent 5 years here in Calgary as well, and it's good to be back here as well.
You're in Calgary today. This is a live edition of the podcast. What brings you to Calgary? You must be interested in energy again.
Certainly, the interest in energy is much better than it was 5, 6, 7 years ago. I even remember 2018. The stocks all looked pretty good from valuation metrics, but the price and COVID just wiped that all out. But yeah, I'd say the tone across the country is that energy, we need it. We need to grow it. I think with Trump coming in and probably some shifting political tides here in Canada as well, we're going to remember again that the Canadian energy patch is, a very valuable resource for many different reasons, not just economically, but security wise. Keeping the lights on, keeping our homes warm. So I think there's going to be a little bit more interest in that for the next 5 years than there was the last 5.
Better than importing oil from Saudi Arabia.
Saudi Arabia, Venezuela, Iraq, Iran. And, that's what's so funny. If we're going to talk about a current topic, the tariffs and the threats that we're hearing, I don't see how putting a tariff on Canadian energy makes any sense whatsoever because just as this is our strategic asset, Canada's energy patch is probably the most strategic asset for the U.S. as well. All the barrels, all the gas can only really flow one way. And anything that the U.S. government would do to encourage and, particularly unite Canadians across the country in different provinces to push us to export that energy to, overseas to the coast is not good for the American economy longer term. So I don't see why tariffs, our viewpoint is that that's not going to happen, but crazier things have happened.
I was going to get into tariffs later in the episode, but maybe we'll touch on it now. In simple terms, a tariff is an extra cost for the importer to pay on the product. So you have to pay more to bring in oil from Canada. So the United States will look for alternatives.
Yeah, I think that makes sense. I mean, usually tariffs, you'll find the exchange rate will adjust to reflect a lot of the difference in the tariff. So you would probably see further devaluation of the Canadian dollar. Certainly, if it's a widespread across the board tariff, let's say 25% on all goods and services, that's going to disrupt many industries, especially in the industrial economy, in places like the Rust Belt in the United States that have been hollowed out over the last 2 decades, 3 decades. That's just going to accelerate that, I think. I don't think you're going to see those jobs necessarily moving there right away. You're just going to see disruption and layoffs and those type of activities. So it would just be too disruptive, we think, to the American economy. And that's what Trump, he ultimately, the art of the deal. I'm going to ask for the moon, and if I get a pebble, then I'm going to hold it up high and say, look what I got us. That's how we think this plays out. That's how it played out in 2016. And, that's what we think will happen again.
To get into Murray Wealth and how things are going. 2024 was a good year for the markets in general, but I think it was a good year for the company too.
Yeah, it was a great year across the equity markets. So our funds participated in that. Our 2 core products that we have is our Global Equity Growth Fund. This is global leaders. 75% of that is invested outside of Canada, 25% in some great Canadian companies. And that one did 31% in 2024. It's compounded at a rate of just around 14% over almost the 10 years that we've been running the fund. So pretty happy with the performance in that one. And then our Income Growth Fund. This fund was originally set up in 2015, 2016. Interest rates were, as you know, 1%, 2%. Our view was we don't care about the 60-40 portfolio. We're not going to put clients' money into an asset yielding less than inflation. And there's a lot of, I don't say shenanigans, but, if the interest rate falls from 2% to 1.5%, your bond value could increase because of a concept called interest rate duration. The bond value could increase 25, 30%. So the bond market had some great years in those years. But when we were saying, we're just like, at the core, you're buying something that's going to pay you 1%, 2% for the next 30 years. And that doesn't make sense to us. And, flash forward 10 years later, now when I look on the surveys of bond fund returns, the last 5-10 years, it's 1.5%, 2.5%. Because ultimately we think, unless you're just trading a bond, that's what your return is going to trend towards that coupon rate. So we set up the Income Growth Fund as more of an alternative where saying, why get 1 or 2%? We can get you 5-6% yield on your investment that's going to grow. And I don't have numbers going all the way back to 2015, but certainly over the last 4 years, the growth of the income stream from the Income Growth Fund is increased at a 14% annual CAGR. So we probably a little bit higher given what's happened over the last 4 years, but we want to grow that income stream at a 5 to 10% growth rate per year.
Why was 2024 such a good year in the stock market?
So 2024, I mean, obviously the stock market now is very concentrated. The Mag 8, I guess, if you want to call it, are 30%. I think probably, I'm guessing, but I'd say the next 40 to 50 companies in the S&P 500 probably get you almost to 90% of the way there. And it's just been, I think one fund flow into index funds. That's just driving those markets and those companies higher. Those companies are also the most active in terms of option activity. And when options are active, you have more and more liquidity and volume in those names. So just a lot of liquidity flowing into the top of the index. But then, right across, because I think if you strip out those names, I think the index has only done 12%. The other 490 companies, that's just an average. Like if you own them all equal weighted, it'd be a 12% return. So certainly weighted towards the top end. And, that's been true for the last 2 or 3 years for sure.
The critique is that the unweighted index funds that have that high concentration in the top 10 companies are in for a rude awakening eventually. Does that worry you? And how would you think about that?
So I wouldn't say it worries me, particularly in our Global Equity Growth Fund. We own 5 or 6 of those top 10 constituents as our top 10 holdings, because at the end of the day, these are just phenomenal companies. We don't think we've seen companies like Microsoft, Apple. We don't own Apple, but obviously it's a great company. Apple, Meta, Google, Amazon, Broadcom, NVIDIA, another name we don't own, but obviously, again, you can't argue with anything they've achieved over the last 2 decades. So I'm not worried about these companies or some long-term blow up. I mean, they all, for the most part, 7 or 8 of them trade at still reasonable valuations, 20 to 30 times PE multiple for a leading technology-enabled consumer company is really what a lot of them are, that just are the distribution center for new technology. So even now we're into AI, Meta, Google spending $5, $10, $15 billion a year on data centers, even more than that in some cases. And we just see they're just going to leverage that over their $3 billion users around the world. There's a lot less risk in that versus I'm building a data center on spec to lease out to other junior AI companies who are going to rent the space from me and train. That's certainly where you can get overbuilt. That's where you start to get bubbles and that type of activity. So, we could be on the road to that, but I don't think we're at that point yet. And then just to sort of get back to your question about does that worry me? There are going to be years where those top 10 companies underperform, and maybe they'll massively underperform in some years. And that could be the real economy has a fantastic year, interest rates, inflation come down, and maybe you get superb earnings growth out of the industrial economic base. You get 25, 30%. I could see, we own a couple of small industrial companies that I could easily see doubling in a year or two in the right market. So maybe you get that and you get great performance out of those, and you have a couple of poor years in the top names. But at the end of the day, it's all about staying diversified. We also don't own the index. We have our portfolios, 35 companies with 86% active share in each portfolio. So, we're not too worried about what the index does or doesn't do, but certainly if you're just plowing money into index funds, you want to be aware of what's in them and what you own.
The idea is a retail investor buys the index fund for a fairly safe return that's protected through a bit of a diversification. But the reason it's a concern is that those top 10 companies make up 30%. So if they do go down, it drags down the index sharply.
Yeah. And obviously that kind of goes back to the earlier point. Like if we have a bear market in tech and you get 25, 30% haircuts, we kind of saw that in 2022. And you get, I think even Costco, another great company, it's in the top 10 NASDAQ constituents. And so anytime anybody buys a NASDAQ or ETF, they're also buying Costco. So Costco might get caught up in that. And I think we did see a little bit of that in the 2000 bubble where, names like Home Depot, great growth stories at the time. They still had very strong growth from, 2000 through 2007, but the stock really didn't do anything over that time period. And certainly, those market dynamics could lead to weak returns if we get into that type of market.
However, if you're aware of the makeup of the index, you understand what you're likely to encounter. Markets go up and down.
Yeah, exactly. And, at the end of the day, if you get a 30% haircut in the top 10 companies, hopefully you're getting some good performance out of the bottom 490, and the index maybe has a bad year because of those 10 companies. But, if you've been buying the S&P 500 index the last 2 years, you've been benefiting from just those 10 companies being such a large part of the index. So, puts and takes.
What surprised you in 2024 in the markets?
What surprised me? I think what most surprised me was the backup in interest rates we've seen in the last 4 or 5 months in the United States. We were coming out of 2022, we were pretty bullish that inflation would come back down to at least to where it's kind of is in that 2 to 3% range. Because when you look at what's under the hood of the inflation numbers, housing and shelter is a huge part. And now we're seeing leading edge rents in Canada and the US start to fall. Home prices, the growth in the appreciation of home prices is slowing. So you're going to see that shelter component, we think, slow down. That's going to drive a lot of inflation lower. Commodities, there's a big spike in 2022, but those all normalize fairly quickly in a lot of cases. Gasoline, I think, today is the same price today as it was in 2015. So, we saw inflation coming back down closer. And like I said, I didn't know if it was going to 2% or 2.5% or 3%, but we didn't think we were in this hyperinflation 6% world. That mostly played out over the last couple of years. And then in August, there was that little growth scare, the calls for the triple cut, 75 bps emergency cut by some prominent U.S. economists out there. And it just, since that point, they've just gone straight back up. We're almost back to 5% on the 10-year, high fours. And that really surprises us. We still see a better inflation outlook for 2025. So I think, and that's creating some opportunities, we think, in some of these longer duration assets, real estate, longer term bonds, because, ultimately we do think rates are going to come back down.
This podcast episode is sponsored by Connate Water Solutions. Do you need cost-effective water sourcing options to supply your next drilling or completions program? Connate Water Solutions is a specialized hydrogeology company focused on water well drilling, testing, and water management services in Western Canada and Texas. Contact info@connatewater.com or check out connatewater.com for more details. This episode is sponsored by 360 Engineering and Environmental Consulting. 360 is dedicated to shaping a better future by championing responsible development with a forward-thinking approach. As established leaders in the site closure market, 360 provides innovative solutions to address complex engineering and environmental challenges. From safeguarding communities to preserving our planet, 360 is committed to making a meaningful impact at every step. Discover the 360 vision and learn more at 360eec.com. The reason investors pay Murray Wealth Group to manage their money is to either get a better return than the market can provide or to be consistent. How do you think about providing value to the clients when the markets go down? It's one thing to do when all the markets are up, but how do you remain consistent so that when inevitably the markets go down, clients are protected?
Yeah, that's a great question. And I think part of the job of a financial advisor, a wealth manager for private client at least, is part, I call it personal trainer. Nobody needs a personal trainer. And, I can go on to ChatGPT and say, I'm a 39-year-old male. Here's my stats. Here's my goals. Make me a workout plan, detailed, Monday to Friday. What should I eat? Yet the personal training industry still exists today. And that's because, okay, thanks for the workout plan, ChatGPT, but I'm just going to sit on the couch and watch Netflix. So, a little bit of our job is that it's making sure our clients are making, and, everybody knows the right thing to do, but helping them actually follow through on that. When markets go down, certainly that's when you get the phone calls from clients saying, I'm worried it's going to go down further. Should I sell everything? So there is a little bit of coaching and, being the level head in that type of market. And, I think a lot of it is just that. It's making sure that you're not making the wrong decision at the wrong time. And, we saw that in COVID 2018 growing into year end. There's a pretty brutal sell-off in the market in 2022. Every time, that's when we get the phone calls, and it's making sure that our clients bring them back to that long-term perspective, saying, here's where we are today. Here's what's happened over the last 5 or 10 years. We've seen this before. These tend to be the best buying opportunities. So, take that, whether you want to invest more or just, make sure you hold on to that, to your investment, because switching your style at the wrong time, and that's classic investing. Even professional, allocators make that mistake all the time. How much money flew into real estate and tech, in 2021 at the completely wrong time. And now 5 years later, they're looking to exit, particularly on the real estate side. And I'd say, well, this is probably a good time to start looking at real estate again.
Speaking of doing your job at Murray Wealth and picking stocks, what are you interested in these days? If I'm correct, one of your top picks, Aritzia, is at an all-time high today. So congrats.
Yeah. So Aritzia has been a long-term hold for us. We've owned it since 2018. We just think it's a phenomenal fashion retailer. Fashion, I think, has a bit of retailing in general has a bit of a bad knock against it in the investment world. When you find a model that works and you can scale that model up and you can prove that model can scale, you can get great long-term returns in retailing, consumer discretionary fashion companies. And, look at some other companies. Lululemon obviously is one example out of Inditex, with Zara out of Spain. Another example, we're looking at fast retailing out of Japan. So there are some great growth stories that have compounded over a decade. And, we think Aritzia is one of those companies. And great to see the stock at an all-time high. Certainly the market's giving much more credit to the future growth potential that we see. But this is a company that we still think has a good 10, 15 years of clear growth runway. And there's going to be hiccups. We're going to have what happened in 2023, where the product in that season doesn't sell as well as the year before, the next year. But ultimately, as a company that has demonstrated an ability to adapt with changing consumer tastes over time and continue to win market share.
What else are you interested in?
Yeah, so we're still very interested in the technology stocks. Like I said, I said at the top of the episode, I think there's maybe a few signs that the bubble is starting to form in AI. But to date, most of the spending has been companies direct, Microsoft, Amazon, Google, companies with a direct line of sight to extremely large user base that's just in the early days of adopting these new technologies. So clearly and Microsoft said that we're building to demand. We have our growth plan. We think we're under capacity today. We need this capacity to meet demand we're seeing today. So we're building to demand signals. That type of growth, that's what we like to hear. That's invest away, spend as much money as you can if you think those demand signals are going to be there long term. 2 days ago, we had that announcement with Oracle and OpenAI and SoftBank. And that's where I start to get, okay, SoftBank, they like to throw money, lots of money, make big bets. They're there at the start of the cycle, but they're also there at the end of the cycle. And so this, I think, it's the first sort of ping on the radar that, okay, there's a lot of capital flowing in here. That's usually how bubbles start, is capital chases good returns, and those good returns turn to bad returns, and you still have tons of capital flowing in. So we're certainly aware of that. We're monitoring that. It's always hard to call a bubble or hard to call the top of the bubble. But I think, ultimately, like I said, we're still seeing fairly good valuations on a lot of these companies. We're not seeing anything today that has us too worried that something's going to blow up or this isn't going to work. So yeah, the technology space, and particularly, I said we didn't own NVIDIA, we own Broadcom. It's a very diversified company. They have both software, they make semiconductor equipment, they make networking equipment. So very well diversified within the tech ecosystem. And the only real thing that brings a lot of their business together is that they're selling to large Fortune 500, the top 5,000 customers. And so they have this suite of many different products that they can bring in. And where we're most excited about it is on their custom ASIC platform. So this is what's really been driving the stock over the last year especially in the last 3 months. Some of the numbers they're throwing out just between their top 3 customers, which is pretty well known. It's Alphabet, Meta, and ByteDance, so the TikTok owner. They see, I think, $60 to $80 billion of revenue potential just from those 3 customers. And that's because they have, like I said, large user bases. They can build these custom chips that really just do one job. So whether that's running their recommendation algorithm for Instagram or YouTube, they need a lot of computing power to service at any given time. They have 500 million users potentially using this platform. So they need a huge volume of these chips. And, we just think this type of custom ASIC platform, you're going to see more and more customers. There's rumors that Apple, potentially OpenAI, are looking at engaging with Broadcom. And, we just think that this is where the AI play, as it turns from training to inferencing, this is where you're going to get, we think, the best returns long term.
Would servicing the gold rush be a good metaphor for Broadcom? That the idea is you don't know which winners it's going to play out, but perhaps you want to service everyone and make money that way.
I think so. But if you're using the gold rush analogy, I'd sort of say the picks and shovels to build a mine or to bring a mine up, that's your training. So that's where we're in this huge construction phase. We need data centers, we need training, where we have models. We need to look at every angle we can. That's where the inferencing side and where Broadcom has a little bit more play in. Certainly it still is in, building these data centers, but ultimately these chips get used for the longevity of Instagram and their recommendation algorithm. And they're going to continue to upgrade that. So it still is a one-time sale. There's not like a payment stream that comes from that, but certainly we think there's maybe a little bit more defensiveness in building equipment that services the operating mine versus building the mine itself.
Outside of tech, are you interested in anything else?
Yeah, so certainly on the real estate side, I think there's some great opportunities here. This is a little bit more of your value investment play, and you have to be very asset class specific. In Canada, we're still staying away from multi-residential. So these are the cap REITs of the world, own large apartment buildings. And the play on these over the last couple of decades has just been, they buy these assets, they have low in-place rents, rent-controlled apartments and such. As tenants move out, you can get a big jump up in your revenue, and rents, especially in Canada, have just been increasing constantly particularly over the last 15 years. Now we're seeing sort of the flip side of that. Rents have actually fallen for the first time quite drastically in the last decade. We still have lots of supply of both new rental buildings, new condo buildings, which I would argue are pretty good substitutes for each other. If I can afford a nice condo and my mortgage rate is going to be similar to what my rent payment would be, I might rather just own a condo rather than rent in an old apartment building. And we think some of the population changes, we'll have to see exactly what the growth rates turn out to be and how many temporary residents stay, how many leave, how immigration targets actually shape up over the next couple of years, particularly with the change in government. But we're certainly not seeing, I don't think, the same demand drivers that we saw over the last 3-5 years. So that's one sector we're avoiding. But, company specific, there's we think it's a great turnaround story in Northwest Healthcare. This is a company that owns hospital assets, medical office buildings. They did, under their previous management team, they did overstretch. They overbought some properties, hoping to then flip them to private equity to take management fees off of that. They had too much short-term debt, too much floating rate debt, so they really got caught offside when interest rates went up. But you're seeing it's still an asset class that there's not a whole lot of new construction. The cost to build hospitals and some of these office buildings has just gone up over the last 5 years. They have a new CEO in now who's actually right-sized the balance sheet already, we would argue. They have a strong payout ratio. I think it's going to come in around 80% in 2025. And again, I do think interest rates are still moving lower over the next year or two, particularly in Canada on the short-term side. I think we're going to see that. Obviously, the longer-term rates, we'll have to see how those play out. But it seems like the pain from the higher rates is mostly behind a lot of these companies, and investors just aren't really paying attention. And now you're across the REIT sector in Canada, I think you're trading at 20% discount to NAV. Typically, they trade around that NAV value. So, we just think in terms of, in a world where do I chase technology? Do I buy Costco at 50 times earnings? Where do I think I can get 15% compounded over 3 or 4 years with relatively low risk? I think this is a good area to look at.
This podcast is brought to you by Energy United. Energy United is an organization with a mission to promote practical energy policy across Canada. Energy United is building a community of Canadians that are passionate about Canada's natural gas and oil industry and are willing to take action. Energy United is driving change on issues that matter, all the way from the carbon tax to the emissions cap. Join Energy United to make a difference at energyunited.ca. One way to invest is to pick the things that are out of favor that nobody likes. They're not chasing fads like tech, although the returns in tech have been awesome. Is there a kind of out of favor sector that you are looking at right now?
Yeah, so one of our largest holdings in our global equity growth fund is a company called Linamar. So this is in the auto parts sector. So certainly out of favor for many different reasons. Going back to the pandemic, there was supply chain challenges. So some of Linamar's customers like Ford and GM couldn't complete cars fast enough. So Linamar is not selling more parts to them if they're just going to sit on their Ford and GM shelf. So that was challenge one. Challenge two has been this whole, we're going electric. Oh, wait, no, we're not going electric, where we've seen companies start to ramp up their electric vehicle programs. And then subsequently in the last 9 months, they've really pulled back on those programs. So again, just headaches in terms of supplying the end OEM. They need different parts for different vehicles. So that's been a big challenge. And then as well, Europe's a bit of a mess on the industrial complex over there. So that's been hard on them. But this is still a company that now it's trading at I think a P ratio of around 5-6 times. Obviously, tariff risk too is the auto parts are sort of if it's not the energy patch, it's the auto parts sector and the auto sector that's right in the crosshairs. So almost every indicator is going against them. And certainly, the stock you look at the stock chart, it hasn't gone anywhere for 10 years. And that alone also lots of investors look at and say, why would I buy this? It's gone nowhere for 10 years. Well, it didn't go anywhere for 10 years from 2000 to 2010. And then it went from, bottomed, I think, at $2 a share in 2009. And now we're talking about coming out at $60. The book value per share has consistently grown from, call it $25, $30, 2015, we're almost up to $100. And, some of the acquisitions, I think they've made a lot of acquisitions over the last decade. Some have worked out. They've made new entries into the farming equipment. So we're talking attachments to tractors right across the board. They own a company out of Winnipeg called MacDon. They bought one in Saskatchewan just last year. So they are diversifying their revenue base. These are higher margin products, better return on capital. They also have their division Skyjack, which is scissor lifts and boom lifts and have a lot of ties to the construction industry. So they've become a more diverse company over the last 10 years, higher return on equity because of some of these acquisitions they've done. The balance sheet's very clean. They're buying back stock for the first time in size, I think, as far as I've been covering them. And yet the market doesn't care. So, and that's fine. We're happy to continue to acquire stock in companies when the market doesn't care. We did this with Aritzia in 2023. And, eventually they're cyclical businesses. You're in the wrong part of the cycle. That cycle is going to turn. Is it today, tomorrow, next year, 2026, 27? We don't know. But when it does, that's where you can get those big re-ratings where as long as the company is still making the right decisions underneath the hood, you'll get those higher return on equities, higher return on capitals. And that's when the flows start to happen. You get more people looking at it, more money coming into it, valuations of competitors increase. And yeah, so I think that's the one sector where we're a little bit more bullish than the market is.
All right. Couple questions from X/Twitter.
For sure. Let's do it.
Is that right? This one comes from Value Not Dead Yet. Curious as to Jamie's view on Air Canada, which seems to lag its peers. The long-term story seems solid, but market does not like the cost per available seat mile nor the CapEx coming up in 2025, 2026. Stock price has been down a little bit. What are your thoughts on that?
Yeah, so Air Canada is one of our holdings. We have, I think, a 3% weight in our global fund in Air Canada right now. Certainly, we had a nice run out of the pilots deal from September to the end of the year. But then we got this investor day that everyone was looking forward to where Air Canada was going to lay out their long-term growth plan. I thought they did a nice job laying out and explaining the CapEx budget, how they're going to finance it, why they were spending $10 to $12 billion on new aircraft. And, I think it's a good answer. The answer is they're buying two really types of planes, the Airbus 321 XLR. So these are extended range A321 Airbus planes. And then the Airbus A220, which is the former C-Series plane from Bombardier. And the strategy here is we have hubs in Vancouver, Toronto, Montreal. We have 330 million Americans who want to fly to Asia and to Europe. They can fly on Delta. They can fly on United. They can also fly on Air Canada because of our sixth freedom of air that we have. It's actually a shorter trip in many cases to fly north to Montreal or Toronto, because when you do fly to Europe or to Asia, you sort of almost fly, north over Iceland, over the Arctic, depending where you're going. So flying north, you can actually get a shorter trip. These new airplanes are going to allow Air Canada to go into a city, like I'll pick on St. Louis or Cincinnati, pick up 100, 120 passengers who want to go to different European or Asian destinations, fly them to one of their hubs in Toronto, Montreal, Vancouver, and then 2 of those will go to Prague, 2 of those will go to Munich, 2 go to Paris, 10 go to London. But with Air Canada, with the A321s, that'll allow them to fly deep into Europe. It's going to open up new markets for them. And, their view is if we can grab a 1% market share in the US for these international flights, then that for us is a huge boost to our revenue sales long term. So that's the strategy. The market still is very focused on current trends in terms of costs for 2025, 2026. I think they wanted to see a little bit more capital return, even though they're buying back tons of stock today. They're projecting that's going to slow down as we get out into 2026, 2027. But no, I think this is a company, we've seen a couple of their US peers report good numbers. This is a company that at the end of the day has a loyalty program, which is important. They own a lot of their fleet, which is important as well, particularly in this tight aerospace market where there's not good availability of planes. And, now it's up to the company to execute on this growth plan. But if they do, we could see the stock being $40, $50 in 4 or 5 years, we think.
Okay, next one from Nick. What does Jamie think it will take for generalist capital to flow back into Canadian energy?
Yeah, I think the number one thing is export capacity. And right now we already going to be bumping up on the limits of what we have in 2026, 2027, I think, with some of the expansions we've seen. So that's where I think whoever ends up forming a new government in Canada, I think we're hoping it's the Conservatives, and certainly that's where the tide was shifting. But, some of the recent polls have said the Liberals are actually gaining a little bit. We'll see how that all plays out. But regardless of who it is, we need somebody who's going to champion the Canadian energy sector. This tariff threat from Trump, like I said, I don't know how real it is, but it'd be nice just to have an alternative of where that oil could go. And now we do have a more business-friendly government in the US, so if these tariffs don't go ahead, maybe it's more going down to the Gulf. That is a great place to export petroleum products. There's tons of takeaway capacity there. So even just getting more product down to there is a big win, we think. But ultimately, unless we're going to see a super cycle where prices are 90 plus for a prolonged period of time. And don't get me wrong, I think we're still going to get good returns out of the sector, even if we don't see all this, because companies now have taken control of their own destiny. We're seeing healthy dividend levels, healthy buyback levels. And so even if the sector never really comes back in favor, I think the companies can financially increase their stock price just through buybacks, and you can get a good return out of it. But certainly we need more export capacity. And, I think that should be a big priority for whoever ends up forming government here. Ultimately, we have very low cost producers, the Tourmalines, the ARCs, even I think Advantage, Birchcliff. These companies can grow their gas production in a 250 gas world. And I think, again, it just comes back to getting that gas out of Canada. And the closer we can close the gap between global prices, even in the US, it's going to just help the whole sector.
All right, this one's from one more. Adam Smith, bro. How does the tariff situation affect cross-border operations of Capital Power? Is Canada going to be shut out of data centers due to USA reshoring?
So that's a good question, and probably a little bit outside my wheelhouse, but I'll take my best stab at it. Ultimately, I think we are going to need, like I said, there's the training side of data centers, there's the inferencing. I think companies are going to want to build inferencing capacity around the world. Obviously, the model training side, that can happen. There's the sovereign AI aspects where certain companies and certain governments don't want data to be outside of their borders. And so you're going to get some data centers built around the world just for those reasons. But ultimately, I think on the inferencing side, companies are going to need to build that capacity somewhere, and having that in Canada, even if you just service the Canadian users, that's still 30, 40 million people who are using a product. That's a still top 10, top 15 market in terms of economic strength in the world. And, I think we'll get our fair share of it. But in terms of the political games, I think it's still a little bit too early to tell on how that all plays out.
Well, as we come towards the end, is there a message you'd like to leave to investors? What would you leave the investor with?
I would just say what has worked in terms of investing is not what necessarily will work next year. And I think the last 2-3 years, we've seen that the opposite of that more and more, where, like I was saying, the Costco's, and there's a lot of stocks we sold. We bought them at a 20p multiple. The multiple went to 30 or 35 times. And we said, that's a little bit too rich for our blood. and then the multiple's gone to 50 times. Multiples, they're not going to continue to rise in perpetuity. So lots of investors aren't even looking at that. They're just looking at earnings revisions and momentum indicators. But, I ran a screen on Canadian companies, and I think I found 40 or 50 companies with free cash flow yield in excess of 10%. That's just, you have to get into the weeds on what the company is doing. Is that all their cash flow? Are they investing to grow their capacity 5-10%, and they're still left with 10% left over? At Canada, the energy patch is a perfect example of that. And eventually these things do revert. Every company will have its day in the sun. 21 and 22 is a perfect example for the energy patch, where 2020, nobody would look at an oil stock. In 2021, nobody would still look at an oil stock, yet they all returned 300%. And then not until 2022 did you get another 100% in the first 2-3 months. And that's when you get the eyeballs coming back to it. And since that point, some stocks have had good runs. And so you got to look where nobody else is looking. And I think we're getting closer and closer to, particularly Canada and some of these companies we've talked about, seeing better investment returns and better markets overall.
Thanks a lot for your time today.
Yeah, thanks for having me on, Trevor.
Is there anything else you want to add?
I think that's it. I think we're good.
Well, maybe see you next time in Toronto on a snowy day again.
Yeah, or you can come in the summer and we'll hit up a Jays game and get some sun and some beers.
Sounds good. Thank you.
All right. Thanks a lot.
Hello, listeners out there. Thanks for checking out the podcast. Hopefully the episode provided some insights. If you enjoyed the show, check out trose.ca, where more episodes are yet to come. You can also subscribe to the podcast, where your token of support is much appreciated. Until next time, happy coffee drinking.